If everybody could take a seat, we'll go ahead and get started. We've got a long evening ahead of us in a good way. Welcome to Urban and the new facilities. Thank you guys for coming, and thanks in particular to Arch Capital that's helping host the event, and thanks to or sponsor the event, I should say, and thanks to all the folks at Urban who've helped to put this on. As you guys can imagine, an event of this size is neither inexpensive nor easy to pull off, so thanks to everybody for all the help. Tonight we'll have two panels that'll run until roughly 7:45, and then we'll have another reception until about 8:15 plus or minus. I'll say a few words to sort of tie the thinking behind the two panels together, and then we'll wade right in to the first panel. But again, thank you guys for coming, for braving the heat and the 5 o'clock traffic. This is a fun way to kick off the urban space, a fun if wonky way. And I will note that the picture behind the title is unintentionally ironic. When we say administrative reform, we mean that which can be done without the help of the building behind it. So keep that in mind as you hear us. So for the last 10 years of debate over housing finance reform, much of the focus has been on how to reduce the dominance of Fannie and Freddie in the system. So whether it's talk about winding them down, which is frankly where the discussion started a decade ago, or more recently talks of merging them into a single entity of some sort, whether it's a government entity or a utility of some sort, or spinning them back out into the private market, but with more competition. Almost everybody, with some exceptions, has been focused on ways in which you can deal with what many have viewed as sort of the central problem in the system, which is this too big to fail dynamic at its core. And so that's what we're going to focus on tonight. And we're really going to focus on it across two dimensions, which I think of as sort of the twin pillars of the dominance of the GSEs over the decades. The first is in their ownership and management of the infrastructure that connects the primary market up with the secondary market. And the second is their assumption of the lion's share of credit risk in the system. And we're going to focus on them not legislatively, which is the way we tend to have talked about this over the last decade or so, but administratively. So what is it that can be done without the help of the folks pictured behind us? What is it that Treasury and FHFA in particular can do to take us down that road? So that's the question we'll ask over the course of the two panels. But I'll note one thing before we wade into the first of these two discussions that's worth noting. There's been a lot of focus and attention in the last couple of months on administrative reform since Mark Calabria's taken over at FHFA. A lot of talk about administrative reform, but interestingly, the focus has been more on what it takes to get Fannie and Freddie out of conservatorship, and a lot less on the sorts of stuff we're going to talk about today. So a lot less focus on, at least overtly, on how to reduce the dominance of Fannie and Freddie, and a lot more focus on what it's going to take to get them out and about again. And so one question that will hang over both these discussions, I think, will be how those two themes talk to each other in a way. So is it the case that reducing their dominance is in a sense a necessary condition for responsibly reprivatizing them? Or is it an impediment? That is there something so central to the model of Fannie and Freddie that they need this dominance, this duopoly to work? I myself struggle with this question a little bit when I think about reform. I think it's a tricky one, but it'll be interesting to hear how, over the course of the two conversations, that tension gets played out. Because you hear these two conversations, how to reduce the dominance of Fannie and Freddie, how to get them out of conservatorship, they sort of run in parallel with one another without conversing much. And they're going to have to be resolved, I think, as policymakers struggle with where to go next. So with that as a backdrop, we'll go ahead and move to the first topic of discussion, which is the infrastructure that connects up the primary and secondary markets. And we've got a really good panel to discuss that. 4 folks that are as equipped to talk about that as you could find. First, we've got Ed DeMarco, who was the the first director of FHFA, so the first regulator or conservator of Fannie and Freddie as they went into conservatorship, who's now the head of the Housing Policy Council. And you've got Eric Kaplan to his left, who has thought about these issues a good bit from the capital markets side of things in particular, who is now the director of the Center for Financial Markets at the Milken Institute. And then to his left, you've got Maren Casper, who heads up Ginnie Mae, which is a critical player in the space, as you'll hear, another GSE that's in charge of the very infrastructure we're talking about. And then all the way down there at the end, we've got Mark Zandi, who many of you guys would know as a commentator on these issues going back a decade plus, who's now the chief economist at Moody's. So thank you guys for being here. So let's start by level setting in a way. Let's start by describing exactly how the system today works. A lot of folks in this room know it pretty well, so apologies. But there's a fair amount of misunderstanding about how the nuts and bolts of the system today works. So it feels right to clean that up a little bit before we debate about where it should go from here. So Ed, talk us through how Fannie and Freddie connect up the primary market, so the world of lenders and borrowers, with the secondary market, the world of investors.
Sure. You know, it's interesting because the history of this go way back to 1938 when Fannie Mae was created. I mean, that was basically the point. The government had created this newly created FHA mortgage, and Fannie Mae was supposed to be an entity that expanded the capacity, the market availability for investing in these FHA mortgages. So they were supposed to buy these FHA mortgages in the areas where loans were being made and sell them in the capital centers of the country where there was that kind of capital to invest in these new, what were long-term mortgages, right? 15-year amortizing mortgages. Fast forward to now, I mean, that's what the secondary market and that's what Fannie and Freddie continue to do. What they do is they help orchestrate and manage a secondary mortgage market that permits a homeowner anywhere in the country that's getting a mortgage to buy a house, get it from a local lender or a national lender, but it connects that local transaction in an order of magnitude, average loan size, a little over $200,000, connects that to global pools of capital to be able to invest in this. But these investors want to invest in scale. So there are three basic steps to this transaction. First is these individual loans have to be aggregated so that you get not a single transaction of $200,000, but you have many loans put together in a pool so that now you're starting to achieve a scale that an investor is interested in investing. So that aggregation is the first step. The second step is the actual securitization itself, the manufacturing and production of a security that an investor, can purchase and know that the cash flows that are coming off from that home buyer get paid through to that investor. So there's the securitization function. And then the third function that's really important is the credit intermediation. A mortgage has basically two risks. It's got interest rate risk and credit risk. Well, the investor in the security is holding the interest rate risk, but Fannie and Freddie have traditionally retained all of the credit risk, so the investor doesn't feel any credit risk if the borrower defaults. So that's what Fannie and Freddie do. That's the securitization process. It's similar things go on with Ginnie Mae. Similar things go on with private label securitization. You have to aggregate loans. You have to have an infrastructure to securitize, and you have to have a way of separating the credit risk piece or investment from the rate investment. So that's the infrastructure that they operate, and Fannie and Freddie do all three of those things. They aggregate, they securitize, and they provide the credit guarantee. I should add at the end of this that that some of those functions are also quite available in the private market. The aggregation of loans is done by private sector participants as well. Securitization, Fannie and Freddie are the dominant securitizers, but we have private securitization, we have Ginnie Mae. And then credit guarantee function, pre-conservatorship, Fannie and Freddie, it was all just a corporate guarantee. They bore all the risk, and now in conservatorship, they do share that risk to some degree with private capital. So we have ways of bringing other intermediaries in to share in holding the credit risk. But that's the fundamentals of securitization.
So that's super helpful. Why do we care? So if you're a consumer, a taxpayer, you're worried about the financial stability of the system, what function does this serve other than moving liquidity around the market?
So what it does is it opens up the pool of investors that actually want to invest in these mortgages to go beyond the banks that are operating in that consumer's community. It opens it literally to the global capital market. So you have a much broader pool of investors. That makes the market deeper and more liquid. It means for the consumer, it means the mortgage rate's lower. So that's the benefit for the consumer. Now for the taxpayer, a little bit more of a complicated issue, right? Because when where that credit risk goes and how much capital is there is a question. And the reason Fannie and Freddie ended up in conservatorship is that there was not enough capital at those two companies to sustain the credit losses that the companies endured during that.
So we'll get to that part. That's very helpful. So, Maren, you guys do, in some respects, something very similar. That is, you connect up the primary and the secondary market as well, but you do it a little differently than Ed has explained for Fannie and Freddie. Can you explain what's similar and what's different about how you guys do this?
Sure. So there's, at a very high level, a lot of it feels quite similar. And I think the nuances of where it's different are where we spend most of our time and most of our attention. So I think they're really important as to where we are different from the GSEs. For the first thing that's different is the borrower that we're serving. And that's different for a couple of reasons. One, we are serving the borrowers that are served by the federal loan program, so the VA, the USDA, and the FHA. And that is important in a couple of reasons. One, we're not setting the credit standards. So we're takers of the volume of the credit, of the loan programs in the federal government. So they're setting the credit standards. They're therefore setting the footprint that the government's going to have. And we're aggregating all of that volume. Second, we aren't necessarily securitizers of that. It's the issuers that are issuing the security in our program. And that's important for a couple of reasons. One, that means that they're bearing more risk and they're continuing to have greater obligations than the GSE model. And this is because Ginnie Mae doesn't use its balance sheet in the same way that the GSEs do. We really only use our balance sheet in a time of stress, or as we call, extinguishing our borrowers. And that actually is an important nuance because, again, more responsibility, particularly at a time of stress, relies with the issuers in our program and the counterparties in our program. So we really focus on the counterparty risk as where the federal loan programs are focusing on the credit risk. And today that's really important because, as everyone in this room knows all too well, and is something that we continue to talk about and continue to grapple with, is the shift of the counterparties in our program. We at Ginnie Mae have a greater reliance on non-banks than the GSEs. So our issuance today is about 80% non-banks and 20% banks. Prior to the recession, it was an exact inverse of those two numbers. So that creates a need for us to continue to look at the system a little bit differently. And the GSEs, it's about a 50-50 split. So we feel it greater in the government side than in the GSEs. And that's important because when an issuer fails for Ginnie, it's much more, I wouldn't say catastrophic, but the impact is much larger than in the GSEs. I think because the GSEs are master servicers, they can move portfolios, they can do things, again, they can use their balance sheet in a way that we can't. So when we have an issuer failure, we feel it much greater at Ginnie than I would say the GSEs do. And so that really kind of brings to bear how we address counterparty risk and where we continue to evolve there. And I think we have to be leaders in that space in the ways that GSEs don't. And then I would say the last big difference, which I think goes without saying, is kind of the legal nature of our guarantee. So the Ginnie Mae guarantee was created in law in 1968 when Ginnie Mae was created, when Fannie was sold to the private market to raise money for the Vietnam War, and Ginnie Mae was created then. So our guarantee goes back into law, and we all know the history of the implicit guarantee and kind of why we are even here today. So those are the primary differences. Who we're serving, therefore what our footprint is a little bit different. How we use our balance sheet and thereby how we look at the risk is a little bit different. And then just the nature of the guarantee, which matters in law and also matters in many cases to a lot of investors around the world.
Okay, helpful. And another way to think about it, and tell me if this is wrong, is like I think of the Fannie Freddie model as sort of a guarantor model. Lenders are selling their loans into a channel that's how they get the credit risk off of their books. With you guys' channel, they're getting the credit risk off their books through FHA, USDA, VA, or however, and then they get the wrap with Ginnie, but they hold the loan or the pool of loans. But the economics are equivalent in the sense that lenders are able to get the economics off their books, take that capital, and then make more loans, allocate it elsewhere. Is that kind of a fair?
That's absolutely right, except for, I would say, in a time of stress, the lender, where the issuer in our program is making principal and interest payments on behalf of the borrower until such time they're getting reimbursed by the federal program, so FHA, VA, or USDA, that there's a time gap there.
Sure.
Whereas if you're participating in the GSE program, they're going to buy that loan out at 120 days, and it's off the servicer's books. So I think yes, all of that is true, except for in a time of stress. And so that's basically what we often are spending our time thinking about is the except for in a time of stress. This is why Ginnie Mae has, this is why it's more important at Ginnie Mae and why we're more important to the housing market in this regard.
Got it, okay. And then the benefit of the channel that you're providing is roughly what Ed said about the Fannie Freddie benefit. That is, you're connecting up borrowers in some sense with international investors that are providing liquidity, which is lowering the cost of mortgage for those guys. So
we're very mission driven, right? Because we're serving the borrowers that the government is helping.
Right,
So,
okay. So you're
we
doing
really
it for a
have,
particularly important cross-section of the folks that benefit from it.
Exactly.
So, all right, so that's the sort of basics of how the infrastructure part of the system works. Mark, what's the problem? So it sounds like you've got a long-standing infrastructure that connects up, as we've said, investors from all over the world with borrowers, and it benefits borrowers by bringing down the mortgage rate. It benefits by, we haven't talked about this much, but by providing much more access to long-term fixed-rate lending in particular that might not be as available otherwise. What's the challenge? What's there to fix, especially on the Fannie Freddie side?
Right. Well, thanks, Jim, for the opportunity, and Lori for the opportunity to be here at Urban. And I should say, in getting prepared for this panel, I went back and read your paper that you wrote on the common securitization. Do you remember this?
Yeah.
I can't believe it's 2 years ago now. And it's actually an evergreen. I recommend
These discussions all feel dated.
It's just, it really explains things very nicely. So it has held up very well after the last 2 years. Well, in the GSE channel, there's two fundamental problems with the current framework. The first is it gives Fannie Mae and Freddie Mac significant market power. They control the pipes, the infrastructure, between the lender and the investor, and that gives them significant control over all of the parties in the mortgage finance system, the ecosystem. Benevolent dictator, no problem, but these are self-interested. But presumably, if they're not in conservatorship and they're out in the wild in the private markets, they're self-interested, and that gives them control over big swaths of the market in some obvious ways and in some less obvious ways. I mean, the most obvious example pre-conservatorship was that it allowed them to charge different G fees for lenders of different sizes. So it wasn't a level playing field, and they were able to do that because they had this control over the system. And so, in conservatorship, no big deal. Their FHFA kind of manages the system and make sure that they're not abusing this market power, but it's there. And if these financial institutions are privatized in some future system, that would be a concern. That would be an issue, the significant market power that they have. The second issue, and not unrelated, second fundamental problem is too big to fail. These are pipes that are critical to the housing finance system, originating mortgage loans, making sure the housing market's working and thus the broader economy is working. And these are institutions with over $5 trillion in mortgages that they guarantee outstanding. So these are very, very important institutions. And so the fact that they control the process, the infrastructure, makes them too big to fail. They are SIFI institutions, systemically important financial institutions, And that's something that I think everyone would agree is not desirable, that we want to move away from that. And that is a fundamental issue. Let me just say on the Ginnie side, the fundamental problem there, and I think you did a good job explaining, but just to reinforce, is, in my view, FHA was put on the planet primarily, it's very key to providing mortgage credit to underserved communities, low and moderate income households, first-time home buyers. But the number one reason it was put on the planet was in times of crisis, that it was supposed to be there to fill the void when everything was cratering, because this is a direct way for the government to enter into the mortgage finance system in the housing market. And in fact, it's done an amazingly admirable job, right? I mean, you think back, well, there was the Great Depression, and then more importantly, in the financial crisis, you look at the FHA USDA went from barely making a ripple in the market, maybe accounting for a couple % of origination volume in the boom times when the PLS market, the private level securities market, was doing so well, to at the peak, probably 35% of all originations, and probably 2/3 of all the credit risk was being taken by FHA at that point in time. So it filled the void, but it could only fill the void because the lenders were sound counterparties. You know, as you said, back then, most of them were the large financial banks, J.P. Morgan, Wells, B of A, Citi, and now that's completely been upended. That model's been upended. And so you have a lot of non-bank institutions. And it's not that those institutions, those issuers are systemically important. It's not that if they fail, the world comes to an end. But the problem there is liquidity. They get funding from lines of credit from the big banks and from short-term funding markets, and that you can easily see that get cut off in a risk-off environment, a crisis environment, and FHA can't play the role. Ginnie Mae can't play the role that it has historically. So there's fundamental problems in both the GSE channel, but also in my view, in the FHA via USDA
so
channel.
on the Fannie Freddie channel, the reason why the market distorting and too big to fail problem that you point out for Fannie and Freddie isn't a problem for Ginnie, I take it, is that Ginnie is a mission-oriented, government-owned institution that it is quite big in a sense, but it's not too big to fail in the relevant sense of having private shareholders driving for market share in a way that would be a problem if it were privately owned. So that's just to be clear, that's why it's not an issue with Ginnie, it's an issue with Fannie.
Precisely, and also why it's not an issue for Fannie Mae and Freddie Mac while they're in conservatorship.
Yeah, right.
You know, but here we are thinking about administrative reform. You know, what does that mean? I mean, that means something happens with Fannie Mae and Freddie Mac. They come out of conservatorship in some form, some way, and that's what we need to be thinking about. You know, where does a common securitization platform line up in that kind of a world? And if Fannie Mae and Freddie Mac continue to own the CSP and continue to operate the CSP, then we've got these two big fundamental problems. They're too big to fail, and they have market power.
All right, so CSP. So Ed, let's go back to you. So when you were at FHFA, you guys introduced this idea of a common securitization platform, which came to be known as the CSP, which I take it was intended to address some of the problems that Mark has mentioned. So talk us through your thinking when you introduced the idea and sort of what's become of the idea since.
Sure. So we introduced this idea in February 2012 in a document we sent up to Congress called a strategic plan for the enterprise conservatorship. So 2012, been in conservatorship for 3.5 years now. Where are we going with this? I felt we really needed to give the public, we needed to give lawmakers, we needed to give the companies themselves some sense of where are we going. As Mark pointed out, right, one of the things that happened in 2008 when Fannie and Freddie were put into conservatorship is that the decision makers at the time looked at the country's housing finance system and realized that if Fannie and Freddie were shut down because they had failed, the country had no operating infrastructure for a secondary mortgage market outside of Ginnie. And at that point, it was a vastly smaller operation than it is today. And so as part of the the response to this massive systemic event we had, the companies were put in conservatorship in part so that their securitization infrastructure could continue to operate and would continue that pipeline. 3.5 years in, we looked at this and looked at what lawmakers were trying to do, and how do you move away from the companies, these two companies in conservatorship, if you're relying on their infrastructure to securitize mortgages. Furthermore, FHFA wasn't just the conservator of Fannie and Freddie, we were the regulator, and we looked at the underlying infrastructure, the technology and so forth that Fannie and Freddie were operating, and realized neither of them were really robust enough to be a go-forward basis system or platform for the future. And we were quite clear about this in the report. This is not making news, right? We said neither one of these is strong enough to build on. We said if we rebuild this while they're in conservatorship, we're going to be doing it with taxpayer money. And why do we want to do that twice in two companies? That doesn't make any sense. So we ought to rebuild this once using taxpayer money. But let's build it in a way in which we create an infrastructure that Congress could build upon and the market participants could build upon for, to be able to envision and get to a post-conservatorship world. So that was the idea we conceived with the common securitization platform. I really want to hasten. I mean, it's sort of interesting, Mark, you went back to, I went back 7, but I went back to my own works, and what the heck was I thinking 7 years ago? So I went back to that strategic plan and looked at, what did we say? And it wasn't just about the securitization platform. We talked about what did it mean to rebuild an infrastructure for the secondary mortgage market. So we talked about, the data standardization. We talked about document repositories, and we talked about standardization of servicing and standardization of the trust agreement and how that would be done. We also talked about this as being a necessary step, not just for Fannie and Freddie, but really for the market itself. If we were going to bring back a private securitization market, these elements needed to be developed. And so what we set about, and when we announced this in 2012, was we're going to start a path. We're going to start engagement with not just with Fannie and Freddie, but with market participants and Congress to start figuring out, well, how can we, in conservatorship, start developing this new infrastructure? With regard to the securitization platform, here's an interesting thing, right? I mean, they're in conservatorship. Securitization is going to get done through Fannie and Freddie, but we only want to build this once. So what we conceived was to set up this common securitization platform as a jointly owned subsidiary of Fannie and Freddie so that they were both directly participating. But we were quite clear from the beginning. Our vision was that this would ultimately become either a market utility or something Congress could dispose of in the process of housing finance reform. And we said in this report, this is a way for the taxpayer to realize some value from the massive investment the taxpayer had already made in Fannie and Freddie and would need to make if we were going to build this platform. So this was really about creating a go-forward infrastructure the market could build on. Last couple points about it. We really expected there to be a lot of private sector engagement in the development of it. We talked a lot about having an open architecture for it so that we were using technology that was available in the private sector. Things were not going to be built proprietary. We wanted to use the systems that were available. And we were very clear we wanted this infrastructure to have the potential of being available not just for Fannie and Freddie securitization or whatever succeeded Fannie and Freddie in that space. We wanted it to be available for purely private transactions as well. That would really aid and abet the goal of getting greater standardization in the mortgage market, whether it was in the conventional conforming space or the jumbo space. So that's what we were really seeking to do when we launched this process in 2012.
So there's a delta then between where we are and that vision, right? So next week, we're going to issue the single security, knock on wood, hope it all goes well. And it'll be a security for Fannie and Freddie. And it seems to have been built in a way that's going to manage the infrastructure of the securitization of those two institutions. Can you talk a little bit about, just at a high level, the gap that's left to fill between where we are entering next week and the vision that you've laid out?
Yeah. So look, I mean, this is going to be a big step forward next week when the common securitization platform yields this uniform mortgage-backed security. It's something we talked about in that report, and it is a major step forward for the market. It has been developed over these last 5 years as really a Fannie and Freddie focused exercise, and the platform is there to serve them. But I would say that, you know, I would expect that there certainly is an opportunity for this platform to continue to be leveraged for something that goes beyond Fannie and Freddie in the future, and I expect that the new FHFA director is going to want to take a look at that. But the other thing that's happened along with the development of this common securitization platform is that Ginnie Mae has made enormous strides with their securitization platform as well. So if I'm a lawmaker thinking about housing finance reform, I think I got two important infrastructures to look at that both may contribute in some degree to, you know, what the future secondary mortgage market could look like. There's both the technology and the skill and the capacity that's been developed at Ginnie Mae, and there's this common securitization platform. And I think that the vision of, in some sense, melding these or leveraging what they each have to offer in some mix is still available for the future housing finance.
All right, so I want to talk about how the CSP might be expanded and what it can do. And then I want to talk about how it can be expanded and who can use it. So first, let's do what it can do. So Mark, and then Eric, I want to come to you on who can use it and how we can expand the market that it serves in a way. But first, Mark, if we're looking at all the various functions in the infrastructure, as it were, whether it's automated underwriting, master servicing, I mean, there's a whole host of things that that Fannie and Freddie do today that at least potentially could be seen as managing the infrastructure that we're talking about. How do you, at least at a conceptual level, setting aside the practical challenges for a moment, because we're on a panel and we get to do that.
Don't worry about that.
If you're trying to figure out what bucket, the CSP bucket or the private market bucket, a function goes into, what's a conceptual framework you use to decide what the CSP is supposed to do once it's fully sort of baked and thought out?
Right, right. Well, I think there's a few criteria, and this is maybe in no order of importance, just what comes to mind. I'm thinking of this in the context of Fannie Mae and Freddie Mac now being outside of conservatorship in a private world. I think first, enabling competition. That things should go into the platform that would facilitate competition to Fannie Mae and Freddie Mac to address the concern of market power and too big to fail. And competition is an element of many reform plans. So the Corker-Warner plan, the Johnson-Crapo plan, the Mortgage Bankers Association plan. I think the number of different plans have this feature of allowing for competition in the system. And for that competition to occur, it has to be the case that institutions that take credit risk, or other guarantors that take credit risk that come in and enter into the system need to be able to use the platform in a way that facilitates their entry. So those things, those kind of activities that are necessary for competition, for a well-functioning guarantor to enter in, should be in the platform. So those are basic functions, the basic things that we talk about. It might also be, I think you mentioned master servicing. You might want to put master servicing in the platform under that criteria, because that is a lot of moving parts there, high fixed costs, barrier to entry. If it's on the platform, then it lowers the barrier to entry and allow more for competition. That's criteria number one. Criteria number two, might be something that Ed has talked about a couple times, is standardization. Things that we want to be standardized across the system to lower the costs of operating the system and improving liquidity in the system. The most obvious things are things like data, right? You want data standardization. so that, the same kinds of data go into the pipes, same kind of data come out of the pipes. Everyone's doing the same thing so that you don't have this complicated mess of information and data, and that's a barrier to entry. It's a more transparent system, less opaque. That also brings down barriers to entry. So anything that improves the standardization of the system. And then finally, the third thing, this might be a little bit more controversial, and it's thinking a little further ahead, is things that facilitate the regulatory process. So for example, we may want things on the platform that help with cross-subsidization in the system, because we're thinking about a future system where we might not get the cross-subsidy in the system that we get now because these institutions are under government control and conservatorship, and they're forced to cross-subsidize. In reform plans that allow for cross-subsidization in the future, there's a fee charge for all borrowers, but how's that money deployed exactly to get the cross-subsidization that you want to improve access to underserved groups and minority groups and low-income groups? The platform could be, a way to doing that. Or the QM issue. So the QM is like front and center. How are we going to address the QM patch issue, which becomes 2021 becomes a real problem? You could put an automated underwriting system, AUS system, on the platform that allows for the ability of all participants to see what kind of default risk was created by pulling all the different levers in terms of credit risk, not just DTI, which is where the controversy is, but LTV, score, and it can reside on the platform, and that's a reason why it should be on the platform, because it facilitates the regulatory. And finally, make sure you got a level playing field, right? If you want to make sure you have a level, like one of the concerns with a multiple guarantor system, more than Fannie Mae and Freddie Mac out there competing with each other, is how are we going to make sure that everyone is served and that guarantors aren't picking off, high profitable parts of the system and leaving other parts underserved. The platform can be used to make sure that at least we have the information and data to understand what's going on in the system. So I actually think one of the key criteria for deciding what goes on the platform should be to ensure that in some future system, the regulatory process can make sure that we're meeting all these goals that we all feel like we need to achieve.
Okay, there's a lot there. We could do like a whole panel on
But
just one of those.
You gave me
criteria.
the economist carte blanche.
Totally
I don't have to execute.
I know, that's right. There's no like,
that's her problem.
gong show,
That's not my
5 minute
problem.
thing. Yeah, fair enough. So the standardization piece of it, though, brings me to to Eric. So we've been talking about the agency government-backed market this entire discussion, right? We've been focusing on the way in which a common securitization platform might help us deal with some of the infrastructure issues we face within the government-backed sort of part of the market. But Mark's point about standardization sure doesn't make it feel like there's a value there in the non-agency space. That is, it feels like the sort of disconnect between issuers and buyers, investors, the lack of an ability to find standardization in that space has really slowed the resurgence of the PLS market. So is there a value here in thinking about the CSP or infrastructure generally when thinking about maybe not just PLS, but sort of the non-agency market generally?
So first, let me start and say thank you for the opportunity to be here, and thank to the Urban team as well. Mark, you gave me an ocean that normally I'd want to jump in and boil that ocean. There really is a lot, but I'll stick to this topic, and hopefully we'll get to some of those. I want to go back and touch on what Ed said. In the beginning, back in 2012, when you put out the white paper when you were acting director of the FHFA, there was this vision of the CSP as being really a tool or a utility for the entire secondary mortgage market. In 2014, that shifted. It was a fundamental shift and became the CSP under the next director was tied just to Fannie and Freddie. It was going to be built just to accommodate the Fannie and Freddie systems with an eye to potentially opening it up to the rest of the market. But that was a fundamental shift, a true fundamental shift. And it wasn't lost, I think, on either side of the aisle, certainly not from those who, in different legislative efforts, supported this turn back to a larger secondary mortgage market utility. There's one quote I want to read, and I normally don't do this, but I thought this was very telling. And the quote from 2014 is as follows: "We believe it would be a mistake to develop a CSP that was compatible with only the infrastructure of the enterprises." This is November 2014, by the way. "The CSP could be an important tool for encouraging responsible private label MBS activity, but only if private issuers can use the CSP. We hope you will pay close attention to this issue in your role as conservator." And that was a letter from Senator Warren to Director Watt. So this notion of creating a safe, sound, and scalable secondary market utility is many shared it across the board. At that time, we know, even as now, the private label market is very slow in the uptake, as you say. Balance sheets have picked up a lot of the slack. We've gone from 9 or 9.5 mortgages out of every 10 in the few years after the crisis being touched by the government to somewhere around 7. But that's still an agency government-dominated market. PLS has been a sliver of the non-agency market. So up until this year, let's say it's been about 10 to 15 billion, give or take. Most of that's been prime jumbo. Most of the prime jumbo has gone to balance sheets. PLS evolved from 2011 onward. There's a new model. There have been many improvements in PLS relative to pre-crisis transactions, a little more standardization across the board. But even in the prime jumbo platforms that opened up that market, as nascent as it was, there were differences. And whether it was due to economics or lack of standardization, you didn't get the kind of participation from investors that you would need in order to support a market of size. And that's one of the key factors about any kind of GSE or housing finance reform. If you shrink the GSE footprint, where are those loans going to go? They've got to go to FHA, maybe VA, or they've got to go to balance sheets, or they've got to go to...
Good luck with that, Maren.
She's ready for them. Or they've got to go to PLS. And we've seen a growth this year. We anticipate a doubling of size in the private label market to about, let's say, 25 to 50 billion, much of which will occur in the expanded credit space. I want to draw 2 lines of distinction because I think it's important, especially when it comes to standardization, in my view of what the CSP could be for the non-agency market. Prime jumbo and prime non-QM, the IO to the millionaire, the just missed market, those deals, those PLS generally look the same. But the expanded credit non-QM deals that are now out in the market, they look very different than the prime jumbo transactions. And there have been investors who have said that they won't participate in this market because they don't feel that their rights as investors are protected. They expose investors to risks that even pre-crisis should have been borne by lenders or servicers, which now, in the very black and white of the contracts, expose the investors to those losses. So many of the avenues that these investors would have been able to sue upon in pre-crisis deals are no longer available to investors in those deals. And I don't blame the issuers for putting those standards into deals. They're just doing what the market allows them to do, right? They're being rational. They're not being shady. When you look, though, at what you need for a market of size, you're going to need the large institutional investors to come in order to support that market. And once the economics are there, if you get more competition in the non-agency channel versus the agency government channel, those investors have still made it clear they're not going to come in because of the lack of standardization and the lack of best practices. My vision for the CSP and the way that I think it can support a non-agency channel, in which I wish we would have continued to explore had we not taken that detour in 2014, it would create a utility, a separate channel for non-agency, but one that contained what I would consider to be best practices. So best disclosures, best practices when it comes to disclosures, best practices around reps, warranties, and particularly enforcement. And in that way, you would have, and I would only do it, at least in my view of it, for qualified mortgages. So I think of this in the way of if you have qualified mortgages, so loans that have a presumption of an ability to repay, they are less risky. And best practices in your securitization, you can look to the GSEs for the practices, and you can look to the work that various groups, so for example, the RMBS 3.0 task force with an SFIG, which I had chaired, you can come up with a slate of best practices which would ensure accountability and enforcement of the risk allocation that's in the transactions to ensure that investors didn't suffer what I call misallocated losses, so that they were not wearing losses for breaches that weren't detected or enforced. They would not wear losses for servicing errors. So that I think of in the way of a qualified security. You have a security, a PLS, that solves for the ills that we saw pertaining to pre-crisis deals. And if you put that together, I think there certainly would be a cost to the build-out, but I think the benefit that you could get from that channel would be greater participation, particularly from smaller and medium-sized lenders. They would have an option, besides whole loan sales, to bring the loans to the platform for securitization, either their own collateral, or you could think of a sort of a multi-issuer format, similar to the Ginnie multi-issuer pools. And I think that the economies of scale that you would pick up and the better credit enhancement and the greater participation by investors who would now come into the market would pay for the increased cost.
And is it because are investors going to come into that space because they're getting something from the CSP channel they're not getting from current bespoke deals? Is that the way to think about it? What's going to attract? It sounds like you've got to get demand, to go down that channel to attract pull through. Why is the demand going to go there when it's not already in the bespoke channels?
I think it is something of a if you build it, they will come element. Look, we always know the economics have to be there, right? Without the economics, investors won't come in. And I would say that there hasn't been a demand, or there hasn't been a large outcry from investors for new standards or better standards, because relative value is there for the investors in the market. So they're not clamoring, and they can pick up mortgage credit the other way, or through other channels, through whole loan acquisitions, through platforms, even non-QM platforms. Many institutional investors have set up, and there's not so much scale right now that those platforms can't handle the size. But in a market that goes from even now what I consider to be something of a tipping point of 25 to 50 billion up to something that could be 150 to 200 billion, you'll need that participation. And again, those investors have been very clear that once that market becomes interesting to them, once it's worthwhile to do the homework, there's a difference between, you mentioned delta before, let's talk about the difference between the delta between an owner of a whole loan and an owner of a PLS. If you own the whole loan, you have all sorts of remedies at hand to make sure your rights are protected. So smart investors are the ones who understand the differences, look at the current PLS out there, particularly in the expanded credit non-QM, and ask, how are my rights not protected? Where am I exposed to losses that I should otherwise not wear? And that's the difference that I do think could be built into the CSP, or at least certainly we can investigate it, in order to create that kind of security that I do think will bring them.
Got it. Yeah, Ed.
Can I jump in on
Yeah,
this?
sure.
Because, so Eric's raising a bunch of, really important concerns. And since overall the topic here is about administrative, reform and changes, but sometimes we can get a little fixated on just administrative reform as what does it mean for Fannie and Freddie? And what Eric's raising is we really want to bring a private market back. We want to have a private channel, private execution. There are some things that need to be addressed there. And if you don't mind, I'd like to build a couple more ideas here in terms of, administrative reforms that regulators could take that would actually facilitate this. And I think part of it is what is leading to this much smaller PLS space. So one is QM, right? I mean, Eric touched on it, but the QM rule, the way it works, severely tilts this playing field towards Fannie and Freddie. And it's not just that. It makes everybody very skittish about non-QM activity, even though these can be really good loans. And so I think redoing the QM rule to replace this GSE patch, the 43% DTI and so forth, that leads to all the problems with that, and have a QM rule that has a bright line safe harbor that works the same in the GSE and in the non-GSE space is a very important step. Second is, if we're going to expand the pool of investor capital in PLS deals, we've got to get registered deals. All the PLS being done now is being done through private placement, and if we're going to get registered deals so we broaden the pool of investors, the SEC's got to take a look at Reg AB, and we've got to look at those disclosures. The market can't do it. It's a regulation that can't be accomplished the way it's written, and it makes it enormously expensive and challenging. We can bring some standardization here, looking at what the GSEs disclose under CRT, but look at also these private placement deals, these 144A deals that are being done, as a baseline for looking at the kind of information investors want. We can get that disclosure rule addressed. I think that also would help broaden the participant pool, the investor pool here. And then the final thing is, if you want investors coming in and bearing, putting capital up broadly in our mortgage market, replacing taxpayers, those investors have got to have data. They've got to have information about the market. They've got to have historical data. And there's such a concentration of historical loan performance data and appraisal data locked up inside Fannie Mae and Freddie Mac. And if we really want to restore private capital and make this private capital market more vibrant, investors more confident about replacing taxpayers, we've got to make more information available to them. So I think all that builds, onto
Yeah,
what
and
you're saying.
if I can, so a couple of things here. Look, the QM patch, if the qualified mortgage rule is supposed to be about credit, which to me, and you go back and you read what the CFPB issued when it promulgated the rule, it should not be channel dependent. A loan that is creditworthy in non-agency, if you all of a sudden shift it to the GSE, right, it doesn't change the credit, you've just changed the channel and you've changed the definition. Same thing with respect to FHA and VA, but that was statutorily granted. And one of the differences, going back to what Mark talked about, is that FHA and VA and even Ginnie, they're public entities, right? They're government entities, and they operate on behalf of the housing finance system. Fannie and Freddie, and I don't say this pejoratively, they are private entities, right? They're profit-seeking entities. If you look at the Fortune 500 data that just came out, combined, unless I did my math wrong, which is possible, combined they're number 9 in revenue and number 5 in profits, combined. And I don't fault them for that. This is what they do. They're supposed to be profit-seeking companies. You wouldn't give the stamp of law to an entity, to any other private entity. And effectively, that's what you've done with the GSEs, and it made sense at the time. And Ed, you were there, right? It was supposed to sort of settle the market, and it was supposed to sort of wind its way out. Now we see it does continue to enhance the market share that they have. And so, to me, I'd like to get back to a one definition that applies across the board, because it should be loan driven.
Let me summarize what some of these themes that have come together. So one of the challenges, to bring it back to Mark's initial criticism of having privately owned institutions own and manage this critical infrastructure, is they're the standard setter. They're in essence setting the rules for an enormous part of the market, which is itself problematic for the sort of market distorting reasons Mark mentioned at the beginning. But it also creates a whole bunch of unevenness across the market. You've got different disclosure requirements. You've got different data being released that's open in some markets and not others. You've got different regulatory treatments from one channel to the next, QM being a good example. So it sounds like one of the opportunities as one rethinks the way the infrastructure that connects primary and secondary market up generally across all these channels, one of the opportunities is to think about it as a singular infrastructure, set of infrastructures that should have at least a consistent, if not singular, set of regulations that address them, rules of the road, disclosures, and all the rest. So it feels like there's an opportunity to clean a lot of these idiosyncrasies up across these different channels. So Maren, to come back to something Ed had said, which is more structural in nature, given that you guys are doing not the same thing that Fannie and Freddie are doing, but something very comparable, do you see opportunities for syncing the two channels up a little bit, or leveraging some of what Ginnie's done infrastructure-wise over the last couple of years? How do we think about these two channels that have long run sort of in parallel with a little bit of attention given to each other, but not synced up really?
Right, good question. And I think a lot of the answer to that lies with policymakers. And I think, we're in the midst of drafting an administrative kind of responding to the presidential memo in terms of housing finance reform, drafting both administrative suggestions as well as legislative suggestions. And a lot of this would fall under the legislative side, it feels to us. And really, the directive for both HUD and Treasury is a little bit different. Treasury has a very specific directive in which they're working on their plan. Ours, we're working on, given that this is an entire housing finance ecosystem, and we at both Ginnie and FHA play an important role. But I think you bring up a good point, is that should policymakers look to rely more on, one standard technology, it looks as though we have two that perform similar functions in the market. And I do think Ed actually touched on something that probably isn't as well understood as I first thought when I arrived at Ginnie, is Ginnie's technology and our capabilities. I think what's maybe not appreciated by the market is the investment that we've made over the last 5 to 10 years. And I think, and the nuance of that is a little bit technical. So pardon me while I'll go into it. Ginnie is able to use its revenues to spend on technology and to build its platform, to contract with private parties to do so. And we do that, and we have a fantastic CIO who's been with us, I want to say 7 years now, and who has led the way on this effort. It is different. We often get looped into a HUD-wide conversation because Ginnie is obviously part of HUD, and we get looped into this HUD-wide conversation of HUD's technology is awful. Why would we ever move anything from the private sector into what would be government technology that is stuck in the 1970s? And I think there are some FHA folks in the room, and truly no offense to them, but they're subject to the annual appropriations process for the technology investment. So they're subject to the whims of Congress, and where, as you can imagine, when you're trying to run a $1.3 trillion insurance portfolio, it's very difficult to plan for long-term technological investments when you're not guaranteed that funding. So that has really hamstrung the agency, and Brian Montgomery has done a fantastic job of working. Oh.
Don't say any baddies, right?
Okay. Brian's done an amazing job of putting together a plan, and they have the down payment, and they're working on that technology. But I do think that is a common misunderstanding that our technology is the same as FHA's.
So to be clear, Cobalt is an FHA problem, not a Ginnie.
That is absolutely right. And so we've done, I would say the key summary of the technology work that we've done is create, and to make sure that we continue to enhance the platform such that it is state of the art. I think we've also made sure that it's secure. We, on a monthly basis, in an 8-hour period, are processing $40 billion of cash in and $40 billion of cash out in one single day. That needs to be secure and needs to make sure that it's not subject to cyber threats. We've also done so in a way that is volume agnostic and number of issuer agnostic. So we don't really manage Ginnie to be a certain size, but should we ever double in size again or quadruple in size, as we have done in the last 10 years, Ginnie Mae's technology would be able to handle such volume. And then it would also be able to, it's essentially, if you want to think about it as a highway with many exits and many on-ramps, you could merge somebody like the CSP or any other private entity into the Ginnie Mae technology. Obviously, there'd be a bit of a transition period. But to the extent that the CSP is taxpayer funded, as is Ginnie Mae, there probably is an argument to be made that the best of both technologies should be available for the ultimate borrower that's benefiting from this system. So, there is probably some work to be done of, what is it that the CSP platform does today that could either potentially could be better than what Ginnie's doing, or is on par with what Ginnie's doing, or where could Ginnie improve? But I think our capabilities are unparalleled in the market, and we have invested a lot in that. There's two other things that I think we talk about if anyone is ever asking Ginnie to play a larger role, and I think it's something that's probably worth reiterating. The first is the global brand of Ginnie Mae. I'm not necessarily a brand person and put a lot behind kind of marketing, but as I've traveled the world and have interfaced with large pools of capital all over the world, the Ginnie Mae brand is not something that should be overlooked or undervalued in the market. Investors have significant trust in the Ginnie brand. It is in investor guides all around the world. And that's not something that's easy to replicate. We have 50 years of history of never missing a principal and interest payment, and is something that I think I've come to appreciate in my seat at Ginnie. And the last piece, there's kind of the third leg of the stool if you look at technology, the global brand. And I think the other piece here is the process that resides at Ginnie that manages the entire system of principal and interest payments. We know exactly what to do when principal and interest is not in the account of the investor. We then know exactly what to do to go back through the system to find out what went wrong and to quote unquote regulate that system. That is something that I think is something that's been, again, built over time, something that's easily overlooked. I don't think it's easily something that you could duplicate in a quick matter of time. So all of that process is there for not only managing the bond administration platform, but managing the counterparties or the issuers or the guarantors that are part of the system. So I think all of those three key things are important to remember should we talk in the context of CSP or even a larger role for Ginnie.
So, I mean, when I think about syncing these infrastructures up, I mean, if you came from another country and someone explained to you how our system worked, it would be very hard to rationalize why you've got two different highway systems, one of which is owned and managed by this private company, or these private companies that still takes up half the market, another, but has a government backstop in some respects. And then you've got another highway system that runs right next to it. You can sort of see it over the hedges. That's the government highway system. And it's really hard to get from one highway system to the next. You got to get off and back on. It just doesn't seem to make much sense. So if one believes that ultimately it makes sense to sync these up somehow, it's hard to imagine how you do it, I think, if one of the major highway systems remains owned and operated by one trucking company. It seems like implicit in all this is it eventually needs to make it into something that functions more like a utility, which is what the original idea was. So with that in mind, and we don't have to go too far down this rabbit hole, do folks have ideas about what the ownership structure should look like in an ideal world? Marion, I won't ask you to answer this question, but other folks like Eric, how do you think about this?
Well, I mean, look, it's in a world where if we envision greater competition, Director Calabria has said that he can't do it. Of course, it requires Congress, which the guys in the back, not the guys in front.
This is back to these guys.
But he envisions a future where you do have new competitors. The CSP has been built in a way, right? It's under Fannie Freddie ownership. How would a new person come in and attach to that? Right? Just the way it's been built. What would the cost be? Is it possible? How would they attach to the UMBS? Right? All of this right now can be looked at and needs to be determined because there's two paths, as we know, one without Congress and one with Congress. But so let's focus on administrative. It's there's many people out there who feel that, in fact, in some bills that were introduced over the last few years, the CSP ownership would move away from Fannie and Freddie, right? Be transferred to a private nonprofit, or be transferred, become a collective. With payment, right, if it were considered taking or value given for the transfer. And there's so many other elements that would go into that, but it's critical to think that way. Even the infrastructure of the CSP, you talked about the AUS, DURLP being put onto the system. That can only be supported by a credit team and technology, right, and an IT team in order to keep that alive and active. So the ownership and then the build out of the CSP as something away from Fannie and Freddie dominance is a critical piece to moving away from just that, Fannie and Freddie dominance. And again, it's...
So are we talking like cooperative? Are there shareholders to this? Like, Mark, what do you think?
Well, I want to answer that question, but before I do that, I want to just react to the conversation and suggest that we should keep our eye on the ball, that we can do many, many different things. We're all smart people, and we can all get these big problems solved, and making the Ginnie platform work with the GSE platform and solve the PLS problem and, solve climate change at the same time. But, we need to be focused on, what do we need to do to get Fannie Mae and Freddie Mac out of conservatorship into a private system, so that taxpayers take less risk, but we preserve all the things we like about the current system. And to do that, I don't think we would prioritize making sure that the Ginnie platform lines up with the GSE platform, or even really worry about PLS. Because PLS, There's many problems with PLS. Most fundamentally, CRT is problems with PLS. So I'm not sure if you made it easily to get onto the platform, you're going to solve the PLS problem. And by the way, I'm Moody's, right? So I would love PLS, but I don't see it. So I just caution that. Nice to think about, but I would put it low on the priority list in terms of things. In terms of the ownership, I would argue if you want to test the private markets with regard to their appetite for playing a role in the mortgage finance system, we should privatize the common securitization platform. We should IPO the CSP. I mean, that's bite-sized. It's not $200 billion in capital. It's a bite-sized, very clear. It's a utility, classic utility. It's like water. It's like electricity. It's, pipes to get from the primary market to the secondary market. And it's shareholder owned. And we just privatize it and see how that works out. If that works out well, then that gives us some sense of how we might want to move forward with the rest of the system, the rest of the GSE channel. But if it doesn't work well, that also is information. So that's a way to go there.
Ed, do you have thoughts about ownership at all?
Well, if you want to IPO something like that, if you want to raise private capital, they got to know what the rules are. I mean, Congress is going to have to say first, what's happened to Fannie and Freddie? What's the role of a government guarantee, if any? I mean, there's got to be a whole bunch of questions that can only be answered by Congress before I think you can get meaningful private capital.
Sorry, so we're running out of time, so let me ask a final question that this segues to a little bit. So at the beginning I said that the recent rise in interest in administrative reform has been very focused on what to do to get Fannie and Freddie out of conservatorship, with much less focus, at least in public, on how to reduce the dominance of Fannie and Freddie. How do we think about those two themes? Is there tension between them? Is there a sequencing challenge? Are they contradictory? How do we think about weaving these two themes together, things we've been talking about up here, and then challenges around reprivatization? I mean, one of the challenges is exactly what you just said, which is how do we think about reprivatizing Fannie and Freddie in a world in which we've got this existential uncertainty about what the future looks like? Who's going to go and invest in these two institutions that need more money through an IPO than any other institutions in the history of the country, if you are worried that Congress is going to come in 8 months and nationalize you or do whatever Congress might do? So I see that as being a related challenge in this, but how do we think about the relationship between the two themes, reprivatization and constraining them in a way that renders them less of a systemic risk in the system?
So look, I mean, since the theme here is about bringing private capital in, that's what getting them out of conservatorship is all about. There's two basic ways that gets done. One is figuring out ways in which capital get into Fannie and Freddie. The other way is a way to get risk and activity out of Fannie and Freddie and have existing private market participants do this, whether it's MI companies or whether it's pension funds or whom that have stocks of private capital that are prepared to invest and engage in this market. One of the ways is to get the risk out and make that available. So administratively, there's a lot of things that FHFA can do to create greater opportunity with Fannie and Freddie in conservatorship or in whatever sort of post-conservatorship realm or configuration that FHFA is considering now. But I think we do need to come back to the PLS thing, and maybe I just sort of slightly, disagree with Mark. I don't think it's secondary, because if what you want to do is shift risk away from Fannie and Freddie and get activity out there, you can't simply assume that the private sector is ready to take it with the rules and the operations as it is today. We've got to pay some attention to what that pathway looks like to bring private capital in to expand the private securitization market, and I think there are some things that need to be done. But so short answer, though, is administratively, there are things regulators can do to enhance this transition.
Yeah, I mean, Jim, right now, we've been in a strong economy. We have low unemployment. The PLS market, for what it is working. Right? At its size, it's working. I have no question about that. And if you talk, we had a good panel the other day at the NBA, and you had three of the biggest issuers in their fields up there. There's a market right now. The key is, and to quote Director Calabria, who himself was quoting someone else, fix the roof when the sun is shining. We're on offense now. And to Ed's point, we don't want to find ourselves with a runaway market where we have a downturn and PLS has grown, where we haven't solved for the issues. We should know too much to go backwards to 2008, especially when the litigation landscape will look very different. To me, what matters is in the black and white of the contracts, what could happen. It goes for the GSEs, it goes for PLS. So it seems, I have a hard time understanding why we can't go back to just before the shift in 2014 and have these conversations about how to create a utility within the CSP for PLS. If we get nowhere because there's too many operational challenges, that's fine. But it seems to me that the prize is too big, and we have enough mechanics in the industry and in government who can try and make a go of that. And now is the time to do it so that we do have another option to move away from if we do shrink the GSE footprints.
All right, so let me try to play it back to you within the frame that I opened it with to make sure I've got it right. So the idea is a relationship between the conversation around reprivatizing them and the conversation around making sure that they no longer present the sort of systemic too big fail risk that they've presented before, is that reducing their dominance in the market is going to be an important precursor to releasing them into the market. But to do that, you've got to figure out ways to revive the non-agency space to take some of the burden off of Fannie Freddie. Is that the sort of way to connect those dots? Mark, is that how you see it? Or?
No, I don't. I mean, I think the key is to reduce taxpayer exposure. And the question is how best to do that. And the most obvious way is through the credit risk transfer process. That is well trodden. We've moved down the path. It's highly successful. It's getting better by the day. Now we have third-party trusts that allow for issuance that meets various accounting rules. We're getting first loss being pushed out into the system. So, why hit our head against the wall of trying to fix the GSE, this common securitization platform, to allow for PLS, which will be a very heavy lift and cost probably another $1 billion to figure it out, and not just pursue the CRTs and transfer risk out that way. I mean, already, if you look at the numbers, Fannie Mae and Freddie Mac are making 45% of the originations. Fannie Mae and Freddie Mac are probably taking 15% of the credit risk in the system. That's it. FHA is probably taking 35%, and the CRTs are probably taking 20, 25%.
So is your answer then that the precursor to getting them out is just more CRT?
More CRT, transfer the risk. I'm all on board with reducing taxpayer exposure. That's the way to go. And it's not only capital market CRT, it's insurance, reinsurance, all the different mechanisms that are being used to transfer risk, and focus on that. And that's the way the private markets are going to take mortgage credit risk. They're not going to take it through the PLS structure because that's a broken system. Unless a generation from now, the guys that take over, because they don't remember what happened 10 years ago. That's the only way.
A generation from now.
Yeah.
And maybe Eric's young enough that he's forgetting already.
No. Look, wait, I go back. If I can.
Yeah, of course.
So look,
And he is a disciple of Mr. Lou Ranieri, so I can see what the problem is here. Yeah.
But
Lou's watching at home.
Yeah, Lou's watching.
Right. Lou feels as I do. I'll be the first one to say, and I have a background and career in that, among other things, but I would be the first one to say I do not want to see the return of irresponsible PLS. I, like Senator Warren and others in her letter, I want to see the return of responsible PLS, just like I want to see responsible CRT. Anything that we do has to be filled with safety and soundness. Again, we've learned too much. That goes on a loan level basis, primary markets, secondary markets. From a PLS perspective, there are improvements relative to pre-crisis deals, and we could spend days and hours, I'd put everyone to sleep, on what is better and what's lacking. The CRT is, and we'll get to this on the next panel, it's effectively PLS. It's a sub-bond. And by the way, there's one key thing there, right?
That's my point. Yeah.
Fannie and Freddie, and most people have faith in their oversight and enforcement powers. And this goes to the notion of a deal agent, which is one of the key things you can build into the CSP. Fannie and Freddie have oversight and enforcement powers that you don't have in PLS. In PLS now, you have a potentially conflicted party that's called a controlling holder, which is typically the sub-bond, the lowest tranche sub-bond holder. And they can control the trust. So think back to pre-crisis deals. Would you be comfortable if Countrywide were written into the PSA that they could do things like control whether or not to review a breach, whether or not to pursue a breach, whether or not to pursue certain loss mitigation, all behind closed doors? I have a feeling most people would say you're not so comfortable looking backwards. In the CRT deals, Fannie and Freddie make it very clear in their disclosures that they will look out for the interests of Fannie and Freddie. And there are no investors do not have any rights or recourse. Now, most of the investors, if not all the investors in CRT, take comfort that for the most part, the incentives of Fannie and Freddie will overlap with their incentives. But if you go back to 2008, 9, 10, you'll know that that's not always the case. Again, nothing pejorative against the GSEs. They've done a tremendous amount of good things and smart things, but that's one of the features of CRT. So in my view of this qualified security, I wouldn't do it unless you could build in to the CSP this notion of maybe even get Fannie and Freddie to offer it as a fee for service because they have the infrastructure. These are some of the things, some of the benefits that I see as a build out to the CSP for PLS. But remember, CRT also, it only operates within the GSE channel. And we do know that Director Calabria has been very clear that he is going to take a look at the risk profile of Fannie and Freddie, depending on their capitalization, and he may make changes to that as he takes to his role and his time in office progresses. So these are things that we need to see. But again, I go back to the point, not to have the conversations now. I just don't understand why we wouldn't have it, because if we find that it can't be done, fine. That's, again, I don't want to see a responsible PLS, but having the conversations is a free option.
We've run out of time. Final thoughts from anybody? Mark, Ed, Maren?
No, I would just say in terms of administrative reform, I think this administration is pretty committed to doing so in terms of the entire mortgage ecosystem, even when we alluded to, if we're going to make changes at the GSEs, it shouldn't just fall downhill to the government programs. We need to be really cognizant of that. And so I think our reform plan will reflect.
So the answer will be in the reform plan. There we go.
Well, there you go.
Thank you guys very much. Please
Thank
join
you.
me in.
Thanks, Ed. Appreciate it. Thanks.
Thank you guys. Thanks, Ed.
Of course. Yeah, of course.
I thought I'd spice it up a little.
No, I like it. Hey,
Nice.
mention Lou. Anytime you mention Lou. He'll be
We were
happy.
agreeing
That
too
was
much.
fun. Yeah. How are you?
That's okay.
We get off here, get
All
these
right,
mics
yeah.
off.
Thank you. And he's gonna appreciate it.
You got it. Anyway, I gotta go on stage, but we'll get together. That'll be great. Yeah. You're around some? I am. Okay, guys. I start on Monday, so.
It's much hotter up here.
Really? These are the hot line.
Boy, there's a lot of firepower in it.
Hey, Chris, how are you doing?
Good.
Good seeing you. Thanks for coming.
Good luck.
And-
No, of course, this was,
That's right.
Yes, yeah, we sort of did it deliberately, hoping that someone like you would come.
yeah, I was going to say.
Okay. Okay. Hi. Hey, good to see you. Yeah. Thanks. Yeah, thank you. How are you? Congratulations. I know you're in charge. It's awesome.
To you as well.
Not
Yes.
On Monday. So.
Well, he gets the whole federal budget,
Yeah.
right?
How do you pronounce your last name? Stein. Good. Okay.
Yeah.
Good. Well, we're going to get started here with the next panel.
Yeah.
That worked. No. Hi, everyone. We're going to get started with the next panel. Sarah, you got to tell everyone to sit down. So. No respect.
Okay. Hey, everyone, let's sit down. We're going to get started.
So we have another exciting panel, and we're going to get started now. I'm Phil Swagel. I'm with the Milken Institute and the University of Maryland, and I'm going to moderate the second panel. We have 4 outstanding panelists to talk about the dispersion of risk. Now, I know that the end of the last panel, the first panel, they got a little bit into credit risk, so they tried to take our territory. This one's going to be better, so everyone should understand that. I'll introduce the panelists first. It's going from my left to the far left is Mike Calhoun first, who's the president for the Center for Responsible Lending. Then David Gansberg, who's now the CEO of the Global Mortgage Group at Arch Capital. Lori Goodman is next. She's here at the Urban Institute. She's the vice president for housing finance policy. And then last is David Finkelstein, who's the chief investment officer for Annaly Capital Management. And I think we're going to start with Lori, who I know has a couple of slides. She's going to take us through some of the data on the history and developments in credit risk transfer.
Yes, just for a very short time. So what I think is Mark did such a good job of mentioning, credit risk transfer actually started in 2012, and the idea was to reduce the overall risk of Fannie and Freddie, reduce the risk to the taxpayer, put private capital first. And then basically, credit risk transfer grew enormously. So there was like $90 billion of collateral covered in 2013, $378 billion in 2014, $420 billion. And you can see that the last couple of years, 2017 and 2018, it's been about $690 billion in 2017, $643 billion in 2018. Altogether, it's $2.7 trillion of GSE exposure has been covered at least partially through credit risk transfer. And I think there are a couple of things that made the development of this market possible. The first was coming out of the crisis. Investors had actually built a lot of expertise in analyzing credit risk because even AAA non-agency securities had credit risk. They had built the capability at the time when the private label market had disappeared, had largely disappeared. There was still a lot of legacy trading, but volumes were down, and and the expertise was there. So essentially, Fannie, Freddie, FHFA provided a tremendous amount of loan level data, allowing investors to really understand the risk of the securities they were buying. And I think that transparency and that provision of data was actually instrumental to the success of this market. So $2.7 trillion of collateral covered. The transfer risk has a combined risk in force of about $91 billion, or 3.3% of the unpaid principal balance. But this doesn't tell the whole story. And this, I realize, is a little bit busy slide, but it does tell the rest of the story. So there's actually been a huge developments in terms of this market and in terms of the diversity of structures. So basically, credit risk transfer started, of course, with the CAS and STACR deals, and it started with one sliver, 60 to 80 LTV 30-year mortgages. And basically, we sort of think of that as covering the risk of loans already in portfolio, that is, its back-end credit risk transfer to the capital markets. Over time, the range of structures there was expanded to include mortgages with higher LTV mortgages, 80 to 97 LTV, to include more variations in terms of the attachment and detachment points, changes in the structure over time. There's been some whole loan, there's been some jumbo mortgages that have been covered under capital markets transfers as well. From capital market transfers, Freddie and Fannie both started doing reinsurance transactions. Again, transactions on loans already in portfolio to insurers and reinsurers. That is Fannie CERT deals and Freddie Axis deals, and a small amount of back-end lender risk sharing. So you'll notice that sort of 2013, 2014, 90% of the transactions roughly were back-end capital markets transactions, and the balance were institution-based transactions, that is the Axis and CERT deals. Sort of over time, the amount of back-end capital markets transactions, that is the amount of CAS and stacker transactions, has declined. The last few years, it's been around 64 to 65%. The back-end institution-based transactions have grown to the mid-20s. And then you'll notice that there's Freddie and Fannie have introduced the use of front-end institution-based transactions, that is, laying off the risk at the point of origination. This includes the lender recourse deals. It also includes deals with insurers and reinsurers. So that is now up to 12.5% of total origination. So if you look at 2018, Freddie and Fannie credit risk transfer, it's about 65% CAS and stacker and other back-end capital markets transactions, 23% institution-based back-end transactions, and 12.5% front-end institution-based transactions. So it's just been very interesting to look at the diversity of structures. And the diversity of structures is very, very important because each of these structures has their own strengths and weaknesses. So the CAS and stacker deals work great in good times, but spreads may be volatile during periods of stress, providing less protection for the taxpayer. But they do provide a degree of transparency to the market that neither the reinsurance nor lender recourse deals provide. Front-end risk sharing poses greater risk, poses the risk of risk-based pricing in excess of what Fannie and Freddie would otherwise charge, but that can be managed, as well as a low level of credit risk, which can also be managed. Lender recourse is available only to large institutions. So again, there is, every one of these structures has its strengths and weaknesses, and by trying out all these structures, you can actually figure out which work best when and have more strategic deployment of these structures over time. So I think sort of the emergence of credit risk transfer and its growth over time has really been one of the highlights of the conservatorship, because as Mark mentioned earlier, it does reduce the risk to the taxpayer considerably, and you are putting private capital first.
That's great. Well, thank you. Thanks, Lori. Okay, so what I'm going to do is I'm going to ask the other three in turn to make some comments, and then we'll go back and have Lori, and we'll keep going, and we'll have some time at the end for questions. So why don't I start with David? And David, of course, at Arch, his area of responsibility encompasses both CRT and traditional MI. And I think everyone understands that Arch, in particular, is a key source of innovation within the industry. So David, can I throw it to you and ask you to talk about where you see
Thanks very much, Phil. I think, I think that background is important, that, Arch Capital, we are both a key provider of credit risk transfer in the form of primary MI, as well as supporting the GSE credit risk transfer structures, but we're also a purchaser of CRT transactions in that we look to transfer some of the credit risk on our own portfolio to third parties. So we really have a good perspective on, all parts of the transaction. So I think for us, we're both a buyer and a seller, and we think both of them are critically important. So I think when we look at CRT, I think, historically, CRT existed in the form of private mortgage insurance, right? If you look pre-crisis, private MI existed. That was CRT. And today, sometimes we think of CRT as an alternative, but that was really the first form of private MI. The first form of CRT was private MI, and we know how that ended up, right? Coming out of the crisis, both the private MI companies as well as the GSEs themselves had a business model that was buy and hold of credit risk transfer, and they both had the same cycles to their business. Neither one had appropriate risk management techniques to diversify risk, and that's really how we got to the current CRT structure, which is looking for a method to diversify risk, right? To transfer credit risk, to deal with the cycles, so that the GSEs really weren't the only ones holding it. So today, as Lori mentioned, we've got a very robust credit risk transfer environment that spans both the capital markets as well as insurance and reinsurance. It works mostly on a back-end basis, but a little bit on a front-end basis. I think I'll come back to the front end a little bit later and why I think that one is so important. Another issue that we hear with the CRT is really what is the permanence of CRT, right? That's one of the common arguments that we hear. And to me, what that really boils down to is, private capital will be available if private capital feels like it's getting an appropriate return for the risk it takes. So I think so long as that question is answered, private capital will exist and private capital will continue to support the CRT functions. I think things potentially break down when that return is not there and the private market feels like they're not getting what they need. So I think it's very important that we recognize that, and we always keep in mind that there is a lot of permanence there. And whether we call it permanence of entity-based capital or equity-based capital or structure-based capital, I think really what it boils down to is what is that return for private capital, and really whatever form the transaction takes, to me, is a lot less important than the return they're getting. I think as we look to the future of CRT, innovation, which has been critical to getting us where we are today, needs to continue. And you can't accomplish innovation without experimentation, right? You can't have innovation without trying new things. And in order to try new things, you've got to have experiments, you've got to have pilot programs. There's got to be some ability for the GSEs or whoever else is looking at participating in the CRT market as a ceder of risk or as someone who's looking to purchase credit risk protection, to try new structures and try new things. And I think it becomes dangerous to us if we try to restrict that, because then we're stifling innovation and not allowing that market to develop and get to the place where it needs to be. And I think Lori did a great job of pointing out how that market has evolved in a relatively short period of time from being almost entirely institution back-end capital now to a mix of institutional capital as well as insurance and reinsurance capital, and gone from back end to also on the front end. One of the real critical elements of the front end is feedback loop, right? So if you think about the GSEs as the primary purchaser, and when I say GSEs, it's really Fannie and Freddie as the primary purchasers of CRT, and again, using my previous contention that the capital markets will be there to support the structures and the transactions where they think they're getting paid for the risk. If you see private capital starting to pull away, that's a strong message about what's happening with pricing, and it allows the GSEs to react in a certain way. Now, if you're doing that at the front end, that's much more timely feedback, and you don't get left holding large pots of exposure. So I think front-end structures are critically important, and I think in order for that to succeed, you've got to have experimentation, and that means you're going to need to have pilot programs, and some are going to be successful, some will probably not be successful. But ultimately, we need that as an important part of the business development. So I'll probably leave it at that for now, Phil, and as we cycle back, I'll add some of my other points.
Okay, no, great, yeah, thanks very much. And I'm taking some notes just on the sort of key words that we'll come back to, and I know will keep coming up. So there's good times and bad times, permanence, different structures and experimentation and innovation. And I know everyone's going to touch on all these as we go forward. I'm going to go to David Finkelstein next from Annaly Capital. And I know you have views on essentially on what this means for markets, on liquidity and pricing. And I know between you and Mike and the others, we're going to get to what it means, not just for the markets and investors, but what it means for homeowners and families. So why don't I turn to you? And,
Sure. Thank you,
your
Phil. And
thoughts.
I'll try and expand on what Lori discussed as well as what David discussed. First of all, with respect to the evolution of the CRT market over the past 6 years, I think at the outset there was some skepticism whether this would really work, and we can say 6 years later it has been a very significant success. It capitalizes on everybody's core competencies in the chain. Private capital can evaluate and take credit risk. Government can provide catastrophic risk, and the GSEs have proven to be very competent intermediaries of distributing that credit risk. So it's been a good experiment. I do think it should continue and expand. David talked about innovation, and there are ways that we can make it more durable in terms of protecting the taxpayers, certainly, but these do come at a cost. And so separating back end from front end, starting with Cass and Stacker, there are three potential ways that I've thought about that you could enhance the program. One, and this is often talked a lot about in policy circles, is how much risk protection you desire, how far to go up the capital stack. Right now it's a little over 4%. There's been some arguments that it should be higher. And I can say, in looking at every objective model, when you run today's origination through the crisis, you're well protected in the context of 4%. So to the extent there is a desire to go higher up the capital stack and you're relying on private capital to take some of that catastrophic risk, private capital with a much higher cost of capital than the government, you're going to pay a premium for that. And if you were to, say, go up to 10%, for example, the incremental cost of buying that insurance would be roughly 7 to 8 basis points in your G fee, or at least absorption into that G fee, which is in the mid-50s or thereabouts. So you don't get much for it, but the cost can be increasingly burdensome. Another mechanism that we've thought about is how to make execution more predictable for the GSEs. Now, Lori talked about spread volatility. It is the case that CRT spreads, Cass and Stacker spreads can be quite volatile. In one sense, they're the victim of their success because as the markets developed, they become somewhat of a benchmark for residential credit. And as a consequence of that, the sector is often influenced by outside macro factors that influence other markets just because they are a benchmark, and spreads can be erratic, and that puts obviously more risk on execution given the fact that these are back end and execution is based on production from 4 months ago. So that is a problem. One thing that the GSEs might think to do to mitigate that risk is create a structure, which is very common in other markets, namely the commercial and corporate CLO markets, where you replace runoff in a particular CRT structure with new origination which exhibit the same credit characteristics. So say, for example, at the outset of the CRT issue, for the next 3 years, as loans are paid off, the GSEs can replace those loans into the structure without having to sell new CRT at the spreads at that moment. Now, that will mitigate a lot of the pipeline risk. However, it's not a cheap endeavor to do. The private market will charge you probably roughly 100 basis points across the first 0 to 4% of that structure, and that'll equate to about 10 to 12 basis points of G fee absorption. And that's pretty significant, but it is a considerable risk mitigator in terms of one of the primary risks that GSEs face when it comes to execution. Now, given the fact that when you look at execution of CRT in the current market, there is roughly 20 to 24 basis points of compensation left over after expenses, after the payroll tax, and after your CRT execution at the current market. So you can make an argument that, paying 10 to 12 basis points might be a viable investment on a portion of that, of your CRT execution, not a significant portion, but to offset some of that risk. So it certainly should be considered. Another potential path is to sell more first loss. Initially, 6 years ago, the market wanted the GSEs to have skin in the game, and so it was recommended not to sell first loss so that the market could get comfortable with GSE origination and the credit risk. Beginning in 2015, they began to sell first loss risk, and it's become more common today, particularly by one of the GSEs. Now, the market does charge a premium for expected losses. There's variability in that, and it's going to charge you certainly more than the risk premium, as well as what the GSEs are often willing to pay. But given the fact that markets or spreads are quite variable, there are opportunities to sell first loss risk when it's optimal to do so, like in the current environment where spreads are relatively tight and you can lay off some of that execution or some of that first loss at an economical level. So I would say that that's something the GSEs should think about episodically in terms of enhancing what they're distributing to the private market. So 3 things: up the stack, wouldn't recommend, too expensive for what you get; a revolver type structure where you're able to replace runoff; a worthwhile investment for a portion of the loans and something that should be considered; and then episodically selling more first loss. But again, these do come at a cost, and when profits become less available in times where markets aren't as good, it's going to push the GSEs to the limits. Now, that was just on Cass and Stacker. When we think about some of the front-end types of transactions that are occurring in the market, we're absolutely supportive of those being more common for the exact reason that spread variability can pose execution risk. So how we think about it, however, is that in normal functioning markets, capital markets execution, given the liquidity and the transparency, is always going to be your lowest cost execution. Markets aren't always normal functioning, obviously. And so when you have the ability to engage in transactions that are less focused on capital markets, you tend to see spreads or costs that are a little bit more stable. And we see this every day in our business. We have 3 credit businesses, each with direct lending platforms, including residential whole loans. And these sectors we see day in and day out, they're a step removed from capital markets, and we see much more stable pricing. So we're definitely supportive of the GSEs further pursuing these tracks. Now, there are a couple of caveats. Number one is obviously they are more expensive to execute. The baseline price is going to be higher. We see it in CIRT, for example, where the backward or back end tranches are roughly 5 basis points more in terms of G fee that it costs to lay off that risk when you normalize for the attachment points and detachment points. If you want it front end, whereby you can lock in some flow, and there were deals done as recently as last year where pricing was locked for roughly 6 months, it's going to cost you an incremental 3 basis points or thereabouts. So all in about 8 basis points. But you're terming out your risk in terms of managing your pipeline, and you face very little execution risk over the not too distant future, 6 months or thereabouts. So it's something we would recommend. The lender-specific transactions are good. We've actually explored them ourselves. We've negotiated where we would lock pricing for a year, as well as volume with one specific lender through one of the GSEs. However, again, the starting offer on that transaction would be 50 basis points above Cass Stacker execution. we didn't execute on that. We did not agree to those terms. So, you know, if you're, let's say, 100 basis points, it's going to cost you about 3 to 4 basis points in additional G fee or absorption. So something to consider. Another point with the lender-specific transactions is you could potentially face adverse selection in the event that that became much more robust. There are, in spite of the fact that credit may look very similar across the GSE bucket broadly, different originators have different credit characteristics. For example, originators with much faster prepays tend to have better credit because there's less opportunity for life events and defaults. And so you could see specific lenders with better credit channeling their CRT through these transactions, and then you end up with the worst credit lenders going through the cash stacker market, which ultimately would be borne, the cost would be borne by the GSEs because we're going to charge more for that. So I'll leave it at that.
Great. No, thank you. Again, I'm taking notes. I want to just turn to Mike and then Lori next. But just for everyone else to think about, I was very interested in the idea of the market not insisting on the skin in the game from the wanting the first loss credit risk, which is really an interesting development. And so later on, any thoughts on that I'd be interested in. But why don't I go first to Mike and then and take it away. And I know you have thoughts on all of this, and I know you'll talk about what it means for families and homeowners and the market.
Yes.
So please take it away.
So today we've been talking about GSE reform, and there are really several different layers, if you will. A lot of what we've talked about has been, if you will, the plumbing, how many GSEs, how they're organized, relate to each other. And then above that is what the regulator will do, conservator-like powers, how will that be preserved after conservatorship. I think everybody generally supports a very robust oversight from the regulator. That was one of the big reforms in 2008. But underneath all of that is the capital rules for how much capital is got to be set aside, no matter who the players are. And importantly, who pays for it? How is it distributed? How is it calculated on an ongoing basis? And it turns out that those decisions have by far the biggest impact on a lot of the questions that borrowers really care about. Can I get a mortgage? Who do I get it from? What's it going to cost? What kind of housing market is there going to be? So I'll go through some of this, and I promise I'll jump in at the level of detail you've become accustomed to today. So one of the big surprises when you dig into the capital rules is that by far the biggest part of the fee, that the risk that the GSEs carry and the risks that they price into the G fee is for a repeat of the 2008 crisis, because you have to put a big pile of capital away for that, and you have to essentially pay rent on it. Investors want to get paid for tying up that capital there. But if you look at the overall G fee, just the rent on that capital to guard against the 2008 crisis is about 2/3 of the G fee, 2/3 of it. All the rest, that remaining third, covers losses through the business cycle, overhead. Those are very small compared to that. So that is sort of the surprising tail that wags the dog of what risks the GSEs have. It was that risk that put them into conservatorship. And I think as Director Calabria has made clear, because of that, he wants to make sure that taxpayers are protected. And it's largely the capital rules that decide how well taxpayers are protected. But those capital rules, again, it's 2/3 of the G fees, but it's distributed very much more heavily to lower wealth working families. So they pay for that rent on the capital for the catastrophic risk, up to 10 times what the very top borrowers are paying for it. And so when you change the cost, how much capital set aside, what rate of return, it makes a huge difference. So for example, on a loan today, and similar rules apply, although to a somewhat lesser extent, to the mortgage insurers through the so-called PMIERs that preceded the capital rules here, but have largely parallel principles to them. So if you take a borrower who would get a loan at 4% today as the base note rate, for a low down payment, lower wealth borrower, the mortgage insurance and the elevated G fee can add another 250 basis points of annual yield. So increase the cost of their mortgage by more than 50%. So from the borrower, that's a big deal. Importantly also, these rules affect, to a large extent, as we heard before with the Ginnie and FHA, who provides the mortgage. After the PMIERs was put in place, which imposed similar capital rules for the mortgage insurance companies, it pushed up that pricing and pushed it very heavily, mandated, not what the MI companies had picked as a business model, but mandated that they hold far more of it for the lower wealth borrowers. It meant that almost all borrowers with credit scores under 700 and less than 10% down got pushed to FHA because those were cheaper loans, because as folks know, FHA has capital advantages due to the government backing, and it also has level pricing. It spreads its cost evenly among all of its borrowers, and you can't compete. It's very hard to compete with a GSE loan. And then you go even further. It gets even more particularized. So, for example, the proposed capital rules propose, in addition, surcharges on certain types of loans. So 2 examples. For smaller mortgages, $100,000 or less, they propose raising the G fees by 50 to 100%, so you can get your loan doubled. One that surprises a lot of people is they also propose, if you are a single borrower, single head of household raising a family, that's 100%, and another 50% increase in your G fee, and these are all cumulative. So if a smaller loan with a single family borrower gets hit with both of those on top of the regular. And so these matter a lot. So I'm going to go real quickly, but I want to share just a couple of things. And importantly, this is the first step in administrative reform. The previous administration proposed a capital rule. The current director, Calabria, has made it clear they are going to move first with that, finalizing that this summer, before they get to next steps about what happens about release from conservatorship. So this foundation, they get it. They're putting this down first before they address those other layers. So a couple of things. So first of all, their proposal very much protects taxpayers. It is extremely conservative, and many would say, taxpayers, that's the first maybe priority they want protected. It assumes more extreme stress than the 2008 crisis. So it projects losses for the capital stress that are higher than what the current portfolio of loans would have experienced in the 2008 crisis. And then one of the biggest ones, and it did this for the mortgage insurance companies too, is in calculating how much money is needed to cover losses in the crisis. It assumes that none of those catastrophic losses can be covered by premium earned from the ongoing book of business, which is, even in the crisis, nearly 90% of loans, the GSE loans, continue to perform and pay. And sort of one of the basics of insurance is losses will fall on some small subset of the insured, which will use the revenue from all of them to help pay for them. So, but it sets all of that aside and says we won't count that. And they also set aside, beyond enough money to pay for the losses, an additional capital requirement to have enough money to what they call going concern capital, to run the GSEs in the future, to have operating capital, and that adds to it. And then one of the things, and then I'll stop so we can get into other questions. One of the key questions that they have to decide is, how do you set the price for this capital? So there are a couple of different ways that you can do it. You can say, we're going to project for this borrower what the losses are going to be in the future. That's going to be the amount of capital that the GSEs, or whoever the guarantors are, have to hold for the life of the loan. Or you can say, well, let's look at how the market develops. As they hold on to the loan, the risk generally goes down as you build up more equity, for example. And we're going to take that into account and have a dynamic measure. And so that's largely what was proposed by the previous administration. The big challenge is that in most, first of all, that the housing market tends to be an up and down market, a boom and bust, although they're usually contained at a relatively size that can be accommodated without great disruption, other than the 2008. But most of the run-ups, when house prices increase very rapidly, the losses go down very low because you suddenly got all this extra equity backing every one of your loans. But that usually is followed by a steep downturn of almost equal size to get you back to more long-term growth projections. So a challenge is that the rule proposed by the previous administration is what you would call very pro-cyclical. And it has two things. That means it says when housing prices are going fast, we're going to lower capital standards. And when housing prices decline, we're going to raise capital standards in the GPs you've got to charge. And they acknowledge, to be clear, that that has a pro-cyclical effect, but they wanted to take into account macro conditions in one respect or another. So they're wrestling with how do you address that. We have argued that they should do it much like a lot of the state mortgage insurers require, and that is, in essence, a contingency reserve. When housing prices are going up much faster than fundamentals, whether you compare it to earnings is usually a mechanism, or the long-term growth trend line, you have to set aside automatically a larger set of premiums. You can't hand them out as dividends or use them then to cut your rates. And then that provides both more capital, more stability in the system. And so let me stop there, but I think in a lot of the debate about GSE reform, the weediness, and it gets really weedy, of the capital rule and the capital standards actually predetermines a lot of these outcomes that we think are the big questions that we're trying to answer.
Okay, no, great, thank you. Let me go back to Lori and David Gansberg. I mean, you can comment on any of these, the two of you. It struck me just listening to David and Michael, the interesting talk again about the bad times and cyclicality, and the impact of the capital requirements and the capital rule. And I have in mind Mark Calabria, of course, has talked about a level playing field, which also is interesting, of course, since different firms have different costs of capital. So with that as background, maybe Lori, I'll ask you first, and then David, if you have anything else.
So I think we're actually going into a very interesting period in credit risk transfer, because historically we've had this growing pie. The last couple of years, the pie has been pretty static. That is, the GSEs have actually, the amount of credit risk transfer has actually declined. Both Davids actually said, gee, it'd be really nice to have more front-end credit risk transfer. It's definitely something the GSE should be looking at. I don't think you can but then if you do more front-end risk transfer with a static or declining pie, you actually have to cut back on back-end credit risk transfer, in particular on the CAS and Stacker deals, which actually begs the question, will you end up with enough liquidity in those deals? So, in addition to what David Finkelstein said, there are actually two other things that the GSEs could conceivably do. One is that they could cover more loans, and I think that doesn't work either, because they're transferring 90%, they're covering some of the risk on over 90% of their acquisitions of targeted loans, that is 30-year fixed-rate loans with loan-to-value ratios above 60%. Those below 60% are very low risk. 15-year loans and shorter loans are very, very low risk, and a lot of the rest of the collateral that they're not transferring is very heterogeneous. So, they're already transferring what they can transfer. They can choose to cover the legacy loans. Obviously, they've looked at that, or I assume they've looked at that and decided it's not economic. So they really don't have the room to grow the credit risk transfer pie anymore. And if you add in the fact that, there's a lot of thoughts about shrinking the GSE footprint, what is Calabria going to do? Are there going to be increases in loan level pricing adjustments such that certain types of business like cash out refis or investor properties might be driven from the GSEs toward the private markets if you raise the LLPA sufficiently? You're going to actually have less collateral to do credit risk transfer on. So I think you end up with a lot more friction going forward on how exactly that credit risk transfer is divided.
Interesting. Oh, no, very good. Okay. David, when I come to you first, and then
Yeah.
David, I was going to ask you also about what the point Lori just made. I'm just setting you up to think about it while David's talking about so there's a narrower collateral base if that's the direction that we're going.
It's amazing how much quicker time goes when you're sitting on the stage and you
Yeah.
want to say things versus when you're sitting out in the audience. But just a couple quick points I want to raise. We're talking a lot about capital, and I think one of the critical points we should address is the notion of a level playing field, because credit risk is credit risk. And it doesn't matter if that credit risk is sitting on the balance sheet of a mortgage insurance company or a GSE or a bank or someone in the capital markets or Ginnie or VA or anywhere it is. So credit risk is credit risk. So whatever we decide the credit risk associated with a loan is should be level across the field. Now, how much capital you need to hold against that credit risk? Well, we've got a lot of different regulators, so maybe that answer is going to vary a little bit. And what is the cost of capital supporting that? Again, some chance for variation. What return should there be? Those are all questions that could be, but credit risk is credit risk, and I think in order to create a level playing field and really decide on the direction of housing finance, we need to address that question. And I think FHFA has done great in proposing this capital standard, which certainly it's not perfect, and we, along with others, provided comments on where we think it should be improved. But I think that's a great start in creating that playing field to be leveled. And specifically to CRT, we don't have a level playing field in the CRT in the sense that, what we're talking about here in terms of CRT is almost exclusively a Fannie and Freddie construct, right? That's where CRT exists. Now, a bank who originates a loan and keeps it on their balance sheet and wants to do a CRT, they don't get regulatory capital relief for that. So why should that playing field be different for a bank versus Fannie or Freddie? So I think that's something that we can work to address. And then I think when we move into the world of VA, FHA, Ginnie, Mutual Mortgage Insurance Fund, there's no CRT to be found over there. So that's an area where I think there's potential to do CRT and, in the interest of protecting the taxpayers, which was one of the points that the previous panel brought up. I think that's a great opportunity to do that as well. And so I think whatever solution we take needs to be more holistic than just with respect to the GSEs, because whatever policy decision we make about what's the appropriate cost for a borrower, if we decide to go down some route that doesn't involve something that's highly correlated with credit risk because we have some other notion, well, that needs to then be aligned between the different people who hold loans, the way they treat the capital associated with those, and what their mission might be. So I think a broader solution is going to be required in order for it to work effectively.
No, very good. Okay, let me. Here's the plan. I'll go back to David. I have a question for you, but you can answer it or not, and then I'll give Mike the last word, and then we'll have some some questions. And just as a preview, for questions, it would be great to ask questions. And if you have a statement, then let's just wait on that, and we'll take the real questions first. So like the sentence with a question mark at the end, and then we'll let them. So because otherwise, we all know how that is. Someone's going to get up and start making a long statement. So I was going to ask you about. I thought it was interesting the idea of if the base of collateral narrows, what does it mean for the market? And is the market there to take on the risk that's pushed outside of Fannie and Freddie? If that, I think that's the metaphor that we're thinking of.
And I'll pick up on what Lori spoke about loans that are not sold into CRT versus those that are, and talking about 60 LTV and below. As a taxpayer, I don't want the government to buy risk on that asset. Certainly, it's not what I would consider worthwhile at all. Now, that brings up a very specific question, though, with respect to reducing the footprint and what the GSEs will potentially do to reduce their footprint. And take a 60 LTV loan, if it happens to be an investor property, and a lot of discussion is being had about whether the GSEs should be guaranteeing investor loans. But because it's an investor property, that loan entails a 2-point loan level pricing adjustment associated with it. So resi credit currently is a scarce asset, okay? The legacy pre-crisis RMBS have all but paid down. We don't have a lot of PLS. CRT is reasonable, but it's not like it's not anything close to replacing PLS, even with PLS. So what I'm doing is I'm trying to disintermediate the GSEs, and instead of buying a 3% slice, a very small allocation of capital to that mezzanine tranche on a 60 LTV investor loan, I'm going directly to the originator and buying the entire loan. Now, that happens to be one of the loans you really want in your guarantee book. It cross-subsidizes, and it's very complementary to the rest of your book. So it's not a great thing for the GSEs, but nonetheless, what's going on right now is the private market, because of scarcity of resi credit and a contraction in spreads, we've now gotten to the point where we're looking for assets anywhere we can find them, and it happens to be the case that the GSEs do guarantee a lot of loans where the private sector does have a better bid. So, just getting into the overall footprint reduction, there's a lot of low-hanging fruit, investor loans, second homes, and even adding LLPAs to higher loan balance loans. But keep in mind, these loans are the better credit loans typically, and they provide a lot of cross-subsidy. And credit investors, private capital, is going to be very discerning, and we will buy the good credit, and the GSEs will be subjected to adverse selection from that standpoint. So that's just something to be mindful as we think about this.
Great. No, thank you. Mike, do you want the last word, and then we'll have some questions?
So I think it's important to put the CRT part, which we're very supportive of. It's been a great development. But put it into a little perspective, because, again, you have to dig into the numbers. They talk about what aggregate volume of loans have some credit risk transfer. But if you compare the total amount of credit risk, it is still a relatively modest slice. So as set out in the capital rule, they give credit for the CRTs. And depending upon whether you look at the single-family book or the overall book, that reduces, the CRTs reduce, as of 2017, the credit risk by 15 to 20%. So the GSE credit risk will be post-MI. They're talking about the CRTs, the back-end CRTs rather than the MI there. So the GSEs still play a really critical role there. The programs can be expanded, but there's still a significant amount of risk management that they are doing within the GSTs. And then my final point would be to pick up on a question that was asked before. Another somewhat of sleeper issue is it was asked, well, what about a utility structure where you have a regulated rate of return? That has profound impact on a lot of these costs, because again, how much that cost of capital, which is both the amount and the rate of return, drives the system. And essentially, the investors are going to get the Treasury rate of return that the GSEs will invest safe capital in. And then the G fee, if you will, has to make up the difference, say in today's market between a 3% Treasury or less these days, and whatever market rate they're shooting for, whether it's 13, 14%. So the G fee is essentially making up that gap, and that cost is being passed on to borrowers in the G fees. If you reduce that rate of return to like a utility rate of return, you're now covering, which is typically more like 9%. The G fee now is covering that gap between 3 and 9, which is like 6%, as opposed to 3 and 15, which is like 12%. And so it's a leverage difference. Going to a regulated rate of return really impacts what borrowers pay. And I would just note a wide array of folks present here today have endorsed a utility regulated rate of return. That would include the realtors, the community banks, civil rights and consumer groups, and the MBA. I'll put a note there, they want multi-guarantors, but they want a regulated rate of return of all of them. But that's another one of those, seems like a little add-on there, but is a game changer in how it affects borrowers, and it also actually helps with the safety of the system.
Great. Okay. I certainly have time for 2 questions. I go here and there, if that's okay. So Chris first, and just wait for the microphone, and I think just for the record, state your name and.
Sure. Chris Mayer, Columbia Business School.
Excellent.
I will definitely have a question mark.
I appreciate it.
This panel and the last one had a conversation that mostly takes risk as a given. That is, it's a fixed thing we're allocating out. During the crisis, issues like tranche warfare, principal reduction, differences between where you sat in the capital stack played a critical role on how loans did or didn't get worked out. What are the incentives for GSEs, servicers, et cetera, when you sell off sort of portions of the risk to minimize the risk in the system, given the crisis, if you may only be concerned about either the catastrophic portion or the first loss portion as opposed to the middle?
Great, thank you. And
I'll
yeah,
take
go
the
ahead.
first stab at it, and then
Yeah, anyone.
giving,
and
giving everyone else
one more
time to
question,
pile
so
on.
everyone doesn't need to feel like they have to comment on both questions.
So I think one of the reasons that credit risk transfer has been so very successful and private label securitization has not come back is exactly because the GSEs have a standardized approach. This is how we work out loans. This is enforced, and the market is comfortable with that standardized approach and knows that it's going to be applied to everyone equally, and there's no and it doesn't make sense for them to game for the short term because they're in it for the very, very long term. And I think that standardization has just been critical.
Great, yeah, go ahead.
So absolutely agree with Lori. And you can do that once, but subsequent to that, you're going to get charged a lot of money when you do violate your relationship with your counterparties, I'll say. And another point I'll make with respect to the PLS market that Eric talked about in the last session is that I wouldn't be as concerned about the lack of redevelopment of the PLS market. What has gone on over the last number of years, the evolution of resi credit, given the fact that investors are absolutely concerned about standardization, the fact that they don't have any control over the outcome. They can't select the servicer in securitizations if you're in the AAAs. You can't diligence the loans, and you certainly don't have any influence in loss mitigation. So what has gone on is that the largest REITs, asset managers, and insurance companies have all invested considerably in infrastructure to carry whole loans themselves. So while the PLS market is 10% of what it was in 2007 or less, rest assured there is capital being allocated to resi credit outside of what we see in banks, CRT, and PLS. PIMCO, WAMCO, Double Line all have loan infrastructure. Insurance companies, AIG, MetLife. we have built loan infrastructure, and it's our biggest growth business, as well as numerous other REITs. So don't be as concerned about the lack of PLS origination. It is growing, and it's coming back, but rest assured, private capital is being committed to the space.
Great. Okay. Last question, and we have 2 minutes, so fire away, and we'll get quick responses.
Sure. So my concern is that this is David.
Oh, can you just? Oh, sorry. Go and just so everyone knows.
Sure. I'm David Dworkin. I'm President and CEO of the National Housing Conference.
Yeah. Thank you.
And thank you. This has been a fabulous conference and fascinating conversation. And in all of the layers and layers of details, we have covered many ways to protect the taxpayer, to ensure that we don't have anything happen again like happened in 2008. But we really haven't talked, except a little bit from Mike, about how consumers are going to actually get loans. And I'd like to know, we have seen over the last 10 years, fewer and fewer people be able to get loans that are more and more expensive. And so what we have is all these tools that help us raise the price for those who need it the most at a credit level that still exceeds irresponsible credit during the crisis. It's much safer now than it was then. And so where are we going to serve these people? Because in fact, in the case of black home ownership today is lower than it was when segregation was legal in 1968. And so I think there's a track record on how the system is working today, and I don't hear a solution about how we're going to actually address
Okay, so
that problem.
you got to state a question.
That is the question: is how are we going to serve the unserved communities that have basically been cut out of the mortgage finance system in the last 10 years?
Great, thank you. This is a super important question. Let's get some quick responses. Any?
I'll just say quickly, certainly it's a challenge, and with the changing demographics of America, it's becoming a bigger and bigger percentage of potential homeowners. So I think number one, regulation of the originators is a big issue, and that regulation turns into cost. And the cost to originate a mortgage is higher than it ever has been, and it keeps increasing. So I think lowering the cost to originate mortgages is an important consideration, which is somewhat outside the issue of credit risk. So I think if that can be solved, that will go a long way toward helping it. And I think if we want to have some program that provides subsidies, I think we all need to acknowledge how the program should work and be able to quantify what it is. If we're not willing to distribute the true cost of credit risk among borrowers, well, let's understand what we're really committing to, and let's quantify what that impact is, and let's all agree that's a good notion, and then act from there. But I think we need to acknowledge it and measure it and understand it before we can create a solution.
Mike, do you want to
add one thing, and that is that I agree credit is tight. We're taking half the credit risk that we were taking in 2001 to 2003, a period of reasonable credit standards. It's a very, very, I would argue that it's the best way to build wealth as a society. We should be taking more credit risk. But I also want to hark back to something that Maren said, is that when you're sort of thinking about it, you have to think about it holistically. The GSEs do risk-based pricing. The MI, and if you're over 80, you need MI, which also does risk-based pricing, whereas FHA does not do risk-based pricing, and the result is that most of the riskier loans, those with higher LTVs and lower FICO scores, are going the FHA route, and so we really do need to think about this holistically.
And Mike, final word. I know we're in overtime, so final word.
So two things. As we talked about, who pays for the capital is a big driving factor. And to be clear, the regulator decides how that's distributed. It's distributed much more heavily on lower wealth households as a result of PMIERs than it was by the business decision of the MIs pre-PMIERs. It shifted dramatically after that, and they essentially dictated that lower wealth households are going to pay the lion's share of a systemic failure, which we believe goes far beyond the normal idiosyncratic individual borrower risk or bad borrower behavior. That hopefully is addressed by QM. The second is we are looking at a market dominated by more lower wealth households, and I think connected to your comments about the cost of originating servicing mortgages, we've got to have mortgages that are structured that can handle better the volatility of income, more lower wealth borrowers with less cushion in a more efficient way than our current mortgage does.
Great, thank you. Now, Lori, did you have
Yes, and
one last?
I want to
last word?
thank you all for coming. I want to thank our wonderful panelists on both sessions. I want to thank Arch Capital, our sponsor. A couple of reminders for future events. Save the date, October 23rd, for the Housing Finance Policy Center's October Symposium. Our theme is Reimagining Housing, Closing the Equity and Supply Gap. It's an all-day symposium on October 23rd. We're doing a data talk on Black home ownership in July. The date is TBD with more details to come. If you're not a Housing Finance Innovation Forum member and are interested in learning more about the program, there's information outside you can pick up on your way out, or talk with me, Elena McCargo, my co-director, or Todd Hill on details on how to become an HFIF member. And please, the reception is going to continue until at least 8:15, so enjoy another drink. We certainly will.
Thank you.
An excellent job.
Yeah, no, that's good.